Let's get started. My name is Tim Hart. I'm a Director of Private Mortgages Australia. Thanks for joining me on this Thursday morning. What I want to talk to you about today is a little bit more about private finance, but in particular development finance. It's an area of finance that is exploded at the moment, just with the banks are lending significantly less than they were, very picky about who they lend to, but even when they do lend, we're seeing them lend at much lower loan to value ratios now. So we've definitely seen a lot more people coming to us for development finance. So hence why we wanted to do this webinar on it. So let's get into it. So the first thing, just to let you know what we do at Private Mortgages Australia, there's sort of three broad products that we offer. First one is a first mortgage. We do anything from 1 to 2.5% per month in terms of interest rate. As you can see, our average loan usually goes for about sort of 6 months sort of mark. So it's very much that short term in nature, which is why we quote interest rates on a per month basis. We pretty much do anything from 2 months. 12 months is quite a long loan for us, but we will do a first mortgage up to 36 months if required. We do anything up to about $2 million in-house. Any amounts over $2 million we can still look at. We just don't always 100% fund them internally. The second one we do is second mortgages, a little bit more risk associated with the second mortgage, so the interest rates are slightly higher in that 1 to 1.5 to 3.5% per month. Same sort of thing, we'll do anything from 2 to 12 months and then anything up to $1 million. The last one is a caveat where you literally need to settle before we've even got time to register a mortgage. So this is when a client needs to settle yesterday or within a couple of days. Much more risk, obviously much more expensive interest rate as well. Very much designed to be very short term in nature. So the other big question we always get asked is, how much will you lend in a certain location? So this is our loan to value ratios. Now you'll notice we break it into category 1, 2, 3, and 4. These are based on the Genworth financial postcode categories. So that if you don't know, category 1 is most residential properties are category 1. Anything that's in 40 to 50 k's of a major city like a Melbourne, Sydney, Brisbane, even your major towns. Category 2 is a little bit further out, still quite a big town, but not sort of in a metro setting. Category 3, much smaller towns and much more rural. And category 4 is sort of affectionately known as whoop whoop, something that's in the middle of nowhere, usually a very, very small town or even farming in nature. And you'll find a lot of banks and even some private lenders won't lend on category 3 and 4. Most prefer to only do category 1. However, we still will lend there, just obviously at slightly lower loan to value ratios. The other thing you'll notice as well, we actually have a maximum. So as much as we say, category 1 residential will do to 75, we actually have discretion to go up to 80% on that. Okay, so look, it's really done on a case-by-case basis. And today we're talking about development, same sort of thing. We normally tap out at about 65. We do have discretion to go up to 70%. As long as it makes commercial sense, that's what private lending is all about. It's all about being flexible, which is why we get a lot of business from the banks who are incredibly inflexible. So let's get stuck into development finance. So there's sort of three main broad development finance products. The first one being senior finance, who most people are familiar with, like a construction facility or the like, where the bank takes a first mortgage. The term is anything from 12 to 24 months, and will do up to a 70% of GRV or gross realization value. If you don't know what gross realization value is, that is the end value of the product once it's all been finished. The second one is mezzanine finance, where we'll sit second place to like a bank, like a first mortgagee, and same sort of thing. It will only go up to a 70% of gross realization value. And the last one, which not a lot of players in the marketplace do, is actually completion finance. And this is where you've got a half finished development, which no bank likes. Banks usually like to get involved at the start of the project before anything's happened, or when it's 100% finished, and there's this icky bit in the middle where they don't like incomplete sites. So We call it completion finance, where we can provide either a caveat or a second mortgage, usually just for a short period of time to finish off something. And I'll go through an example of that in just a moment. This is a little timeline sheet thing, I guess, I've put together here, so you guys can sort of see, when everything happens. So usually senior and mezz is all done at the start. Completion finance is much more towards the finish of the project. All right, let's go through just a couple of examples. So the first one is a case study of a senior finance deal we did probably about 6 months ago now. It was a development site up in Willowvale, up in Queensland. It was a land subdivision of 1 into 5. The borrower actually owned his own home, like it was just, he's living on a big chunk of land, but he wanted to keep his own home on 1 title and sell the remaining 4 lots. Okay, fairly common situation. He had actually pre-sold 100% of the 4 lots, and the bank finance was unavailable due to a lack of serviceability. So just with Private Mortgage Australia, we're not really interested in the serviceability, because our loans are usually prepaid. So it's more we're focused on the exit strategy, how they're going to repay the loan at the end of the term, rather than servicing it along the way. So the solution we gave him, the valuation came in at 2.125. We gave him a first mortgage of 1.475 million. The loan to value ratio was 70%, and the interest rate was 1.5% per month for the 5 months. Another case study we've got here of a mezzanine finance deal we did a development site in Glen Waverley in Victoria. It was a 3 townhouse development, and the borrower wanted to develop to keep, which is in the industry is a nice way of saying I've got no pre-sales. So the bank finance was basically unavailable due to this lack of pre-sales. So that's where we came in and could help out. Valuation was 4.58 million. He already had a loan with HSBC, and we provided a second mortgage to sit behind that of 1.358 million. Total LVR of 64% and an interest rate of 1.95% per month for the 12 months. We also did that one on a sort of a drawdown basis as well. So he wasn't paying the interest on the full amount, obviously, until he sort of needed that money to complete the project. Last little case study I wanted to share with you here is a completion finance deal we did over in Altona North development site. They did a 3 townhouse development. They had 2 of them pre-sold. And what they were trying to do is they were trying to self-fund the development, and they were almost hoping that the builder would finish doing all the work and they could pay him at settlement. And he wasn't prepared to do that. He was owed about $300,000, so they basically run out of money. They were 90% complete. They were literally 2 months away from finishing everything. So myriad of reasons why they couldn't get bank finance, lack of experience. This was their first development, incomplete security, also lack of serviceability. They were self-employed, hadn't done their financials. So we came in and sat second place. We did a second mortgage for $435,000, which enabled them to finish the project. And that was at 1.9% per month, just for the 2 months. All right, so there's a few case studies, so you can get a bit of a feel for what we do and sort of the rates in the marketplace. But interest rate is only one aspect of a private loan as well. The other thing you need to be aware of is the approval fees, or sometimes called establishment fees, because there's a significant amount of work that goes into putting one of these loans together. So we have our approval fee table here. So you'll notice, for instance, anything from say $500,000 to $1 million in loan volume, we charge a 3% approval fee, and included in that is a 1% referral fee for you as the referrer. Okay, so Our referral fees, as we've got there, are channel agnostic, meaning it doesn't matter if your client comes to us directly or they go through you, it's the same cost. Okay, so there's no benefit for your client coming to us direct, which was really helpful for a lot of our referrers as well, because they wanted to make sure that their client wasn't going to come direct for whatever reason. That they're still going to go through their broker or their referrer, and they'll still get paid for it. The only other fees that we charge an upfront assessment fee, which covers the cost of our title searches and title checks and bankruptcy checks, even desktop valuations, and that's just $550 to $770. Okay, really just based on the complexity of the transaction. Any legal fees are always done at cost. Evaluation, if it's required, is done at cost as well. So we literally don't make any money until the loan settles, which is how we like it. Now, the other way we work with referrers, in addition to getting your share of the approval fee, we also allow referrers to charge a referrer service fee, or you can mandate your client directly as well. Okay, so depending on how much work is involved, especially when it comes to development, there can be a lot of work involved in the transaction. So before we issue our letter of offer, you can nominate what you'd like as a service fee. So it might be an extra 1%, or it might be $1,000, or whatever you want to nominate. The other thing we pay is subsequent referral fee paid even if the client comes direct. Okay, so this is our way of saying that if you refer someone to us, that they're your client, and we will pay you for the life of that client. So if you introduce us to John Smith and he borrows some money, he then comes back to us again, but comes back to us directly, we'll still pay you your share of the approval fee, even though you weren't involved. Okay, which is actually a bit of fun for us. It's always nice to call up some of our regular referrers and sort of say, look, can you send us a check an invoice for $5,000, because we just did another loan with with John Smith, or whatever the case may be. So it's just us sort of making sure that we're looking after the people that are bringing our business in. Now, the only circumstances where that wouldn't apply is if John Smith went and engaged another referrer, and that referrer then sent us the client. Obviously, we're only going to pay one referral fee. So that's the only circumstance where we wouldn't pay a subsequent referral fee. And the last way we reward our referrers is the Referrer Rewards Program. So basically, it's a bit of an extra bonus, really, that as you hit key milestones with us, we have sort of gift cards that we'll send out. So it could be a gift card for Dan Murphy's, could be for Myers, could be for JB Hi-Fi, whatever you want. You just nominate it, and we'll send it out. The other thing that's worth noting on this as well is that each of these milestones are cumulative. So if the first loan you settle with us is for $2 million, then you'll get the $1,000 gift card plus the $500 plus the $250. So you'd actually get $1,750 worth of cards there. As soon as you hit $3 million in a year, you then get $2,500 worth of gift cards. But you also then into the lifetime membership of PMA's Platinum Playground, we call it, and you'll receive an extra $500 gift card every financial year, provided that you settle at least $500,000 with us. So it's just another way that we like to thank our regular referrers, because that's where about 90 to 95% of our business comes from, our referrers. So let's have a look at our application process. And this is literally from inquiry all the way through to settlement. And this process, we've done it in a couple of days before, and most of the time, especially for first and second mortgages, we're sitting around that 1 to 2 weeks. So a lot quicker than your typical bank, which is probably sitting around the 6 to 8 weeks to go through this whole process. What we do, you either submit an application form or a quick app. So our quick app it's a 2-page quick app form. So it's literally just the real high level details of the transaction. And that's all we need to produce and do our initial assessment and produce an indicative letter of offer. So the indicative letter of offer has the indicative interest rate and also the assessment fee, which is payable. We then, once that's been accepted and paid, we then complete our due diligence and issue the formal letter of offer. I would say in 95% of cases, the indicative rate is exactly the same rate that goes onto the letter of offer. The only time it will change is if we find something significant in the due diligence, like suddenly the LVR has gone from 50% to 70%, or something like that. That's dramatically changed the risk associated with the loan. As soon as the letter of offer is accepted, we get docs issued usually within about 24 hours, and then we can usually settle the following day. So it's designed to be a very quick and streamlined process. The reason people are coming to us is that flexibility, but it's also that speed of service as well. So what I want to do just before we sort of finish up here with a few examples is I just want to go through what we look at, what we call our first filter. So how do we actually qualify a deal? And we do this because we want our referrers to almost be able to qualify a deal before they send it to us, okay? Because there's nothing worse on two parties spending a lot of time on an application that was never going to proceed to start with. So the very, very first thing that we look at is the loan non-coded? Okay, so we want to make sure that we're only doing a loan that is for business purposes. So if someone wants to buy their own home or borrow some money to buy a car or go on holiday or anything like, we can't lend money for that purpose. Okay, more than 50% of the funds have to be for a business purpose. Now, one of the easiest ways to make a loan non-coded is if it's a company that is borrowing the money, so it's a corporate borrower, that's automatically deemed to be non-coded. Okay, so nice and easy check there. If it's a commercial property that's been used as security, same again, it's automatically deemed to be a commercial loan or a non-coded loan. And when we talk about coded, we're talking about the National Consumer Credit Protection Act. That we don't want to be able to, don't have the licensing to fall under that. So it's all business only lending that we do. The next thing is the client prepared to pay at least 1% per month? Okay, because it doesn't matter what the loan transaction is, it's the minimum we'll ever charge is 1% per month. So we just want to make sure that the client is not expecting to get bank rates at 5% per annum or 0.5% per month or anything like that. That this is very much short-term private finance. The next one is the postcode and the loan-to-value ratio. So that little table that I showed you at the start that has our postcode and loan-to-value ratios, we just want to make sure that, that the client's not trying to get a 90% lend on a property that's in the middle of nowhere. Okay, so just making sure that it sort of adds up and that they're asking reasonable loan-to-value ratios based on the location of the property. The next thing we want to know is what is the referrer service fee or mandate? Okay, so we want to know upfront what you want to make to the client, because we're very much all about full disclosure. So we want to make sure everything is in the indicative letter of offer before it all goes out. The next one is probably one of the most important checks is the exit strategy. So now, as you'll see there, serviceability is not required. Okay, most of our loans come with a prepaid term. So it might be a 6-month loan that we prepay for 6 months. So because there is no payments, there's no need for us to do anything in relation to serviceability. And for us, serviceability is more about what is their exit strategy. How are they going to repay this loan in full at the end of the term, be it 6 months, 12 months, whatever it might be. So it might be, some pre-sales. It might be a refinance, once they've completed the project. It might be the sale of an asset, all sorts of different scenarios. But that's we're going to want to see evidence of that and make sure that we're setting the client up for success. That they're going to be able to be in a position to repay the loan in full at the end. Another big one is, why can't the client get bank finance? Okay, we want to know that up front. Okay, because if they can get bank finance, do not use us. Very, very simple. We're never going to be as cheap as a bank, and we don't claim to be. We will be a lot more flexible and can settle a lot quicker, but we really need to understand what it is that's holding them back from getting that bank finance. And so we can sort of see what any issues are with the loan. And the last one, which a lot of lenders sort of miss the point of sometimes, is when does the client actually need to settle? So we like to make sure that we're working with the same timeline as the client, because there's no point in us doing a loan application if they need to settle in a week and it's going to take us 2 weeks. There's no point even getting started. So we like to know up front. And look, we can settle very quickly. We just need to make sure we're all working towards the same deadline to make sure it settles. Okay, so here's a couple other, I suppose, things that we do. We don't just do development funding. Probably our main bread and butter is all around urgent funding, where a client needs funding and they can't wait the 4 to 6 to 8 weeks that a bank takes. We have a real focus on asset lending. So once again, not a huge issue if they can't prove serviceability. ATO debts, this time of year we're doing quite a few of these. Where the ATO is, at the moment, they've been really, really strict on small businesses at the moment, and not allowing, sort of payment plans to go through where they previously would. And a lot of banks will not lend to someone who has outstanding ATO debts. So yeah, we're doing quite a few of those this week actually. So if you have any clients that do have those ATO debts that need them paid out before they can go and get, more traditional funding, we can help with those. Another one, refinancing existing caveat loans. So some caveat loans out there, when they go into default, the default interest rate or the higher interest rate is absolutely horrendous. We saw one the other day. The client was getting charged 15% a month on this caveat loan. So whereas we were able to come in and refinance them with a second mortgage at 2% a month, which obviously, as you can imagine, saved the client tens of thousands of dollars. So something to keep in mind. Another big one, valuation, not contract. Okay, so we live in the real world. We understand you can buy a property under market value, and you can add value to a property before you have to settle on it. So we're happy to lend on the higher of valuation or contract price, which obviously very different from a bank that'll always do the lower of. So we've done lends before where we've lent over 100% of the contract price, okay, because we could see there was value in it, and our valuation stacked up well above it. Another last one I want to sort of mention there is credit impaired. So because we're sort of more asset lenders, credit issues aren't so much an issue for us. It really, for us, comes back down to that exit strategy. How are they going to repay the loan? Now, where someone who's got bad credit or poor credit might be an issue for us is if their exit strategy is to refinance. Okay, so if they're saying, I'm going to refinance and pay you out through, the Commonwealth Bank, but they've got horrible credit, well, then that's going to be an issue for us. We don't want to set them up for disaster, so that so we wouldn't do the loan. Okay, whereas if the sale, they were going to repay the loan from a pre-sale or the sale of a property, then their credit is not going to be an issue for us. Okay, last thing I wanted just to talk about here is just sort of the PMA way, and I suppose it's just trying to be quite different from a lot of the other private lenders out there. There's definitely some sharks out there, and we very much want to distance ourselves from that sort of aspect of the industry. And the ways that we do that is that we keep our upfront assessment fees very, very low. Okay, we've seen people getting charged $10,000, $20,000, $30,000 as an upfront commitment fee, they usually call it. And if the loan doesn't proceed, well, you lose a lot of it. Thanks for coming. Whereas us, the most the client might lose is say $550. Is usually a lot easier sort of for the client to sort of take on. The other thing we have is we have no charging clauses or cancellation fees in our indicative letter of offer. So there's once that's been agreed to, there's nothing else they need to pay and nothing else that they've agreed to until they get the final letter of offer. Any valuations are always done at cost. We're not making any profit on those, and they're also done at a reasonable value. Some of the other private lenders out there, they will do a valuation, but they do it for forced sale, where they basically ask the valuer to do a valuation that's going to come in really, really low. And when you thought you were getting a 60% LVR, it probably works out to be more like a 40% LVR because they've valued the property so low. So we always make sure that our values are done for either market value or for mortgagee purposes. Legal fees, same again, are always done at cost. So whatever our solicitor charges, it's done on a flow-through basis. We have capped interest rate ranges. So for our first mortgage, you know the interest rate will be between sort of that 1 and 2.5, and majority are around that sort of 1 to 1.5 sort of range. We're not going to come back with an interest rate that's going to be 3, 4, 5, 6% a month or anything like that. We rebate unused interest on extension payments. So all of our loans come with extension payments. So let's say we do a 6-month loan that's prepaid for 6 months. We might give that client 3 months worth of extensions. Okay, so it just means that if they get to the end of the loan, it's not just the world, the sky falls down. They can service it and extend the loan. Once they extend the loan, if they settle halfway through that month, we'll actually rebate them any interest that they didn't use. Okay, so the only time we won't rebate interest is during the prepaid term. The other thing we have is custom-built software for faster processing times. We've spent a lot of money building our own software that we can actually process loan applications a lot faster than other people in the marketplace, because that's really what it's all about, is that speed to market of when a client puts an application in, how quickly can we then get money in their bank account. And that's what really helps with us do that. Something we're very proud of is a very high level of repeat customers, okay, that they've had a great experience with us and they just want to keep coming back again and again, and that we always know we're doing a great job when we see that happening. And especially in development space, we see lots of that, developers that are just not getting any love from the banks or are getting caught out by the banks, that'll keep coming back to us, and we'll sort of grow with them as well. So for us with PMA, it's really all about a win-win approach to lending. We want to be here for the next 20, 30, 40, 50 years. We're not one of these lenders that's going to be gone tomorrow. So it's all about having a real win-win approach to lending. So look, that's it. I hope you've found that useful. It's development finance in particular, a really growing space at the moment. Really looking to help out some clients. If you do have a specific loan scenario you want to run past us, please contact our senior relationship manager, Shanta. Her direct number is there, and there's also her email address. Now, for those who have attended, we will send you out a copy of the slides. A recording of this presentation will also be popped up onto the Private Mortgages Australia website under our resources tab. So if you want to watch it again, or you want to show it to some other members of your team, you'll be able to do that. And we'll also send you out a certificate for your CPD points, so you can file them away for your professional development stuff. So anyway, thank you very much for your time, and we look forward to hearing from some of you soon. Thanks.